So you're thinking about selling your auto repair business in the near future. Well, my name's Jim Parker. I specialize in selling auto repair businesses, and I've been helping people sell businesses for nearly 25 years. One of the first things that's going to happen when you want to sell your business is you're going to want to know what the most probable selling price of your business is. So you're going to want to reach out to a business intermediary like myself that specializes in the auto-related industry and get a broker's opinion of value done. One of the things that we need to determine working with you is how much your business is actually making, and that's what I want to talk about today. So there's two different numbers that we're going to be looking at. One is what we call discretionary earnings, and one is what we call adjusted EBITDA. So let's start with discretionary earnings. So discretionary earnings, we're going to be looking at bottom line net profit. How much did you make in your business in that given year? And then what we're going to do is we're going to do what we call add backs, and we're going to be taking things and we're going to be adding it back to the net profit, increasing that net profit line so that we can show a potential buyer how much they could be making from the business if they continue to run the business in the same manner. So we're going to take that net profit and we're going to add back one owner's salary, because we're going to assume that whoever buys the business in a discretionary earnings situation is going to be a full-time owner operator, so that that person would be receiving the compensation that the current owners getting. So it's going to be the net profit plus the owner's salary. Then we're going to be adding back interest expense, because as the seller, you'd be paying off any loans that you would have on the business on the day of closing, and the buyer would be taking over the business free and clear from any of those loans. Now, they might have their own loan, but they wouldn't have your loan. So we'd be adding back any interest expense. We'd also be adding back depreciation, because depreciation is a non-cash expense. So we'd be adding that back 100%. And we'd be adding back amortization if you're taking any amortization, because that's a non-cash expense as well. Then on top of that, any benefits that you're running through the business for yourself or your family, let's say you're taking your health insurance through the business or some kind of retirement program that's benefiting you and your family, we would be adding that back as well. Then we'd also be looking at any like one-time unusual expenses that are unlikely to happen again for a long period of time. So let's say that over your office, you had replaced the air conditioning unit last year, and that cost you $10,000 to replace that air conditioning unit. Well, you're not going to have to replace the air conditioning for a very long time, so we could add back that $10,000 as well. So any unusual one-time expenses that are unlikely to happen again, we can add that back as well. Then we're going to be looking at any expenses that are not really needed for the business. Maybe a car that's used more for personal than for business, and any expenses that are associated with that, we could add it back. Now, we're going to go through and we're going to look at all those numbers, but I do want to stress very, very highly that over the years, I've seen business owners run a ton of personal expenses through their business. And I've seen that. We all know that it's out there and it's being done. If you're thinking about selling your business, even if you're not thinking about selling your business, I highly recommend that you do not do that, or you cut back considerably on that. Buyers want the financials to be as clean as they possibly can. And the more personal expenses that you're running through the business, the more it's going to turn a buyer off. And it could also create a situation where lending institutions like SBA lenders are not going to look at those kind of add backs as well. So if you're running personal expenses through the business and you're going to be selling your business in the near future, stop doing that. And legally, you should be stopping that anyways. I'm not judging. I'm just telling you what I see. And I would love to chat with you more about that, because I do want to maximize what you're going to get as a sales price. But we have to be realistic on what a buyer is going to be willing to do with those add backs, and we got to be keep in mind what a lender is going to look at that as well. So cut back on those personal expenses, and look at it this way: for every dollar you're trying to make write off in a situation like that, even if you're in the highest tax bracket possible as of this recording, that would be 37%. So for every dollar that you're trying to write off through the business, you're saving 37 cents on that dollar. But when you go to sell your business, you could be losing out on $2.5, $3, $4, $5 on that same dollar. So you're trying to save cents and you're losing out on the dollars. So you want to make sure that your financials are reflected as much as you possibly can that are true, accurate business expenses. Now that's the discretionary earnings number, and we put all those numbers together: the net profit of the business, the owner's salary, interest expense, depreciation, amortization, any benefits you're receiving through the business, any one-time expenses that are not likely to happen for a while are being added back, and then certain personal expenses or expenses that are not really needed for the business may be able to be added back, but again, you need to cut that back. That's discretionary earnings. And we're assuming whoever buys the business in a discretionary earnings scenario is going to be coming in as going to be a single owner operator. So they're going to come in, they're going to work full time after they acquire the business. Now, the other thing you need to be concerned, need to know about is what's called adjusted EBITDA. And adjusted EBITDA is the same thing as discretionary earnings. However, we're assuming that whoever buys the business is going to be putting a manager in place or somebody to run the business on their behalf. So we would have to put in the equation, leave money in the equation for the new owner to hire somebody to run the business for them. Now, when do we use discretionary earnings? When do we use adjusted EBITDA? Discretionary earnings is usually on businesses that are smaller, maybe going to sell for a few $1,000,000 or less. And the adjusted EBITDA is for much bigger auto-related businesses. Maybe there's multiple shops or it's a very big shop, and we're assuming that whoever's going to buy the business is going to be a private equity group, maybe an industry player or a competitor that's going to be coming in and acquiring the business. And it's usually done, the adjusted EBITDA is more for the bigger businesses, like I said. And what you need to understand too is that the discretionary earnings number is higher because we're adding back an owner's salary. The adjusted EBITDA number is lower because we're putting a salary in there for somebody to run the business. However, when we look at the multipliers, how we're gonna price that business, if we're pricing it off of EBITDA or adjusted EBITDA, the multipliers themselves tend to be higher, and the discretionary earnings multipliers tend to be lower. So even though the discretionary earnings number is higher, the multiplier is lower. The adjusted EBITDA number is lower, but the multiplier is higher. So it kind of washes out on the end, but it's how you present it to the particular buyers that you're going to be targeting. One last thing that I want to leave you with is that it's really important not only to have clean financials, but to have well-organized financials. Any buyer, whether they're buying a smaller business or a much bigger business, they're going to want to have a due diligence period once they go under contract with you, where they're going to ask you for a lot of information. They're going to be asking you for tax returns, bank statements, merchant service statements, invoices, just a lot of different information, because they want to build and make sure that they can verify the information that we're putting out there. So make sure that you keep your financial information very well organized. You'll be very happy about that when you go take it to the market. Well, I appreciate you watching the video today. And if you want to have a chat with me, please reach out and give me a call. I do want to stress, if you're thinking about selling your auto-related business, please reach out to myself or somebody like myself that specializes in the auto repair industry and that is very seasoned, very experienced, and have that conversation with them. Well, thanks again and have a fantastic day.